ABSA's full-year headline earnings per share dropped 9% to 8.8 billion rand, hit by a rise in credit impairments and its mortgages and commercial finance property book. Loans and advances grew by a modest 5% during the period to nearly 530 billion rand. Samantha Loring asked ABSA's CEO Maria Ramos where they had grown loans and how their market share had done in key areas.
Well, we've focused on a couple of areas. So yes, we have been very prudent in our unsecured lending. In unsecured lending, we made that clear to the market. We've not grown in that space. In fact, we've lost market share in unsecured lending. We've also lost market share in the home loan space. Some of that we had explained in 2011 already. We moved out of the mortgage originators. We're back into that channel. And we've seen some of the business come back, and we're really well placed now, and we're happy with some of the production back in the home loan space. We're starting to see nice growth of good business in our home loans business, and as I say, we're happy with that. We have seen good growth, and in our cards business, we've got a really good card business. And we are fully integrated with Barclaycard globally in the card space. We saw 19% growth in our cards business, and then again in our vehicle asset financing business, we've also seen really good growth in that business. We've reestablished key relationships with dealers. We've improved our processes, and I think we've also made it much easier for clients to transact with us in vehicle asset financing. So in our retail and business markets area, good growth in key areas that we wanted to get back into the market. In our corporate and investment banking business, we've done really good business. So our investment banking business is up on a headline earnings basis 40%, and our corporate business, which is business we've just really moved, part of our strategy was to move it into investment alongside our investment banking business. I think we started to establish really good momentum there, acquisition of key clients, not just in South Africa, but across Africa, and linking up with Barclays globally. So good, strong underlying momentum coming through.
Let's talk about Edcom, because one of the big acquisitions of last year was of their debtors book. You adding 3.8 million customers. How are you going to leverage that further? What's the strategy there? And are you going to be able to cross-sell products, or is it just purely having that customer base under ABSA?
Well, we did the Edcom deal because we wanted to acquire the book as an entry into the personal loan unsecured debt market in a clear strategic way. And so Edcom's exciting for us. 3.8 million customers, about 2.2 million of those are new to bank. It gives us an opportunity to think about cards. It gives us an opportunity to think about a whole range of retail market products. And we're working with Edcom and that customer base on that. We think there's an enormous opportunity and potential to cross-sell into that Edcom space, and we're working on all of those opportunities at the moment. So yes, we acquired it precisely because of that. Fantastic customer base, total about 3.8 million customers, and the opportunities we're exploring are all the way from digital, the digital banking channels and the multitude of product that we can put through that.
And of course, Barclays Africa is the buzz at the moment. When it comes to the actual transaction there, the issues that have been flagged is why is it all a share deal, and why isn't ABSA using some of its cash? Is it because Barclays wants to have a bigger control and bigger stake in ABSA ultimately?
Well, I think Barclays made it quite clear that Africa's a core market, and it wants to be, and it wants to, for them this wasn't about reducing its exposure to Africa. So for Barclays, this was always going to be a share-based deal. So that's one that's important. I think the other thing we should also just keep in mind is there's been a lot of, I've seen a lot of the reports and a lot of the debates out there about, the structure of the deal and the price. If it hadn't been structured in this way, the price would also have to be thought about differently, because the dynamics of the deal would be different.
So would it have been more expensive?
Well, yes, potentially, yes, because you wouldn't have a 1-for-1, if it wasn't a share-based deal in the same way it is. But I think the most important thing here is that Barclays wants to be in Africa and wants to have the exposure to Africa. And so, the cash wasn't the option that was on the table.